Debt consolidation can save you thousands or quietly cost you more than the debt you started with. Most people never run the actual math, so they can't tell which one is happening to them. In this video, you will. Here's the plan. The real math of when consolidation saves money and when it doesn't. Loan versus balance transfer versus HELOC. Why a lower monthly payment is a trap. The behavioral mistake that ruins it. Who gets approved at fair credit. The fees to watch, and a free alternative most people overlook. If this is helping, subscribe. I break down real money situations like this every single week. Drop your question in the comments. I read all of them. Okay, let's start with the math. Debt consolidation only works when the new loan actually costs you less than what you're paying now. And that's not automatic. Let's run a simple example. Say you owe $8,000 spread across 3 credit cards at an average 24% APR. Consolidate that into one personal loan at 18% over 3 years, and 2 good things happen. Your rate drops, and you have a single fixed payment with a real payoff date. Over the life of that loan, the lower rate can save you a meaningful chunk of interest. But here's the flip side. If your consolidation loan is at the same rate as your cards, or barely lower, and you stretch it over a longer term, you can actually pay more total interest. Even though it feels simpler, the one easy payment can quietly cost you. So the rule is this: consolidation makes sense when you lock in a clearly lower APR and you don't drag the term out longer than you need. Always compare the total interest over the full term, not just whether the monthly payment looks smaller. These numbers are an illustration. Your real rate depends on your credit profile, so run your own figures before deciding. There are 3 main ways to consolidate, and picking the wrong one for your situation is where people lose money. Let's compare them. Option 1, the consolidation loan, a fixed-rate personal loan that pays off your cards, leaving one predictable payment. Available across a wide range of credit scores, including fair credit. Though rates are higher, the lower your score. Option 2, the balance transfer card. You move your card balances onto a new card with a 0% intro period, often 12 to 21 months. If you pay it off before the promo ends, you can pay almost no interest. But there's usually a transfer fee of 3 to 5%. You generally need good credit, around 700 plus, to qualify. And if the promo expires with a balance left, the rate can jump to 20 to 30%. Option 3, the HELOC, a line of credit against your home. It can offer lower rates, but it's secured by your house. Miss payments, and on you risk foreclosure. That's a big trade for a lower rate. Quick rule of thumb: good credit and a balance you can clear fast, the balance transfer often wins. Fair credit, or you need a steady fixed payment, the loan fits. The HELOC, only with caution and a stable income. A lower monthly payment is the most seductive trap in all of debt consolidation, and lenders know it. Let me show you why. When a consolidation offer advertises a lower monthly payment, your brain hears cheaper. But usually that lower payment exists for one reason: a longer term. And a longer term means more months of interest piling up. Take that same loan and stretch it from 3 years to 6. The monthly payment can drop dramatically, which feels like relief, while the total interest you pay roughly doubles. You didn't save money. You just spread the cost out and paid more for the privilege. This is why one low monthly payment is the headline on almost every consolidation ad. It's the number that's easiest to make look good. So train yourself to ignore it first. Look at the APR and the total cost over the full term. Then check that the monthly payment fits your budget. Lower payment does not mean cheaper loan. The single biggest reason debt consolidation fails has nothing to do with rates. It's behavioral. Here's the mistake. You take out the consolidation loan, you pay off all your credit cards, and suddenly those cards show a 0 balance and lots of available credit. It feels like a win. So a few months later, you start using them again. A little here, a little there. Now you have the consolidation loan to pay, and fresh card balances stacking back up. You've doubled your problem. This is the trap that turns a smart move into a disaster. And it happens constantly. The fix is simple, but requires honesty with yourself. After you consolidate, treat those paid off cards as if they're frozen. Many people literally stop using them or keep just one for emergencies. Consolidation solves the math problem. It only works if you don't recreate the spending problem behind it. If your credit is in the fair range, roughly $580 to $669, you can still get approved for a consolidation loan, but you need to know where to look. Let's break it down. Big banks usually want good to excellent credit, so applying their cold often just wastes an inquiry. Your better bets at fair credit are credit unions, which are member-owned and tend to be friendlier, and online lenders, some of which specifically work with fair credit borrowers. The catch: the lower your score, the higher your rate, so the math from earlier matters even more. You have to confirm the new rate actually beats your cards. And here's the key move before you apply anywhere. Use soft pull pre-qualification. to compare several lenders without touching your score. Only the lower scoring borrower who shops carefully finds a consolidation rate worth taking. If the best offer you can get isn't clearly lower than your current cards, consolidation through a loan may not be your answer, and that's exactly what the last section is about. Before you sign any consolidation loan, there are 3 watchouts that can quietly eat your savings. Know them so you're not surprised. First, the origination fee. Many consolidation loans charge an upfront fee, often a percentage of the loan, sometimes taken right out of the money you receive. That fee raises your true cost, so factor it into the comparison. A loan with a slightly higher rate but no fee can actually be cheaper. Second, prepayment penalties. Most reputable personal loans don't have them, but check. You never want to be charged for paying your debt off early. If a contract penalizes early payoff, that's a reason to look elsewhere. Third, the longer term. We covered this, but it bears repeating because lenders lean on it. A longer term lowers the payment and raises total interest. Pick the shortest term you can comfortably afford. Read the full terms before you sign. The rate is only part of the real cost. Here's the option almost no one talks about because nobody profits from telling you you may not need a loan at all. It's called a debt management plan, and it can be free to explore. A debt management plan, or DMP, runs through a nonprofit credit counseling agency. There's no new loan and no credit check to qualify. A certified counselor reviews your budget, then works with your card companies to lower your interest rates, often into the single digits, and rolls everything into one monthly payment you make to the agency, which pays your creditors. The trade-offs: you typically agree to close the enrolled cards, and the plan usually runs 3 to 5 years. But for someone with high-interest card debt who can't qualify for a loan at a rate that actually helps, a DMP can beat every option we've covered. One safety rule: stick to legitimate nonprofits. Look for agencies affiliated with the National Foundation for Credit Counseling, (C), or the FCAA. Avoid anyone who charges big upfront fees, guarantees specific results, or tells you to stop paying your creditors. That's a red flag, not help. So here's the whole thing in a nutshell. Debt consolidation is a tool, not magic. It works when the new rate is clearly lower and you keep the term short. It fails when you chase a low monthly payment, stretch the term, or run the cards back up. Compare total cost, not the monthly payment. Watch the fees. And if a loan doesn't beat your cards, a nonprofit DMP might. Run your numbers before you commit. If this helped you, subscribe. I break down real money situations like this every single week. Drop your question in the comments. I read all of them. See you next week.